Welcome to Holistic Accountant Podcast, where we aim to showcase how adopting a holistic approach in accounting and tax maximizes value for clients. Beyond traditional tasks like preparing financial statements and tax returns, a holistic accountant focuses on offering advice that maximizes personal wealth on an after-tax basis. If you enjoy this episode, please consider leaving a rating and sharing it with those who might also benefit. And to ensure you stay updated, subscribe to our weekly email. The link is in the show notes. Okay, today, Mena and I would like to talk about how to structure your property development. You know, a lot of people get into smaller scale property development. They feel very attracted to it in terms of making a quick profit. Who doesn't like a quick profit? I mean, we speak on this podcast all the time about playing the long game and really ultimately trying to build long-term value. And I strongly believe that short-term profit doesn't always drive long-term value. Having said all that, you know, there's a large amount of people out there that do really well from small scale property developing. And so today we wanted to talk about, you know, some of the key considerations that, you know, you need to think about and discuss with your holistic accountant to make that a success. And so the first one is completing a thorough feasibility study on the potential development. And just a word of warning here, I have on a few occasions over the last couple of years come across some clients that have been sold a development opportunity and they've used a buyer's agent to do that. That's great. And these buyers agents have said this is a great development opportunity. And in all cases, it wasn't. There wasn't any profit to be made as a result of developing the property. And as a result, then you can't even sell it to another developer. You know, you can't even sell it to a builder, for instance, because they wouldn't be interested in the project as well. So look, reputable buyers agents offer a fantastic service, but I think the key element there is a reputable buyers agent. In the absence of that, you really want some independent advice. You want some independent advice from someone that has real life experience in these sorts of developments. And so that should be your accountant. I'm not saying all accountants are going to have experience here, but if your accountant does have personal and professional experience in drafting and reviewing feasibility studies, particularly reviewing them, then that's exactly the person that you need to go to from my perspective, because I don't have any skin in the game. That, you know, whether it's a great development opportunity or not, you know, that doesn't matter to them. But of course, the buyer's agent that's recommending the property, it makes a big difference.
Second thing to consider is to plan actually before you do any property development. So you need to get your operating structures right from the get-go. You need to have considerations around land tax, GST, CGT. You know, there's a lot of operative provisions around property development, and if you get it wrong from the start, then it can have some huge tax consequences down the road. As an example is if you don't actually set up your operating structure right before you undertake any sort of town planning activities, and that can be something as simple as, you know, your site survey, which happens at the very start, then you could actually be pinned for double duty. What that means is double stamp duty. So the ATO or the SRO take it as if you've basically, you know, changed the purpose of the land or changed your intention for the land and sold it to a development entity, and you are up for stamp duty again, which, needless to say, can have some significant impacts on your profitability.
The next major consideration is what are you going to do with the asset after it's been developed? So will you continue to hold all the properties and hopefully enjoy some good rental income and potentially, most likely some good tax depreciation benefits? Will you sell one or two and keep one or two, or will you sell them all? And I'll invite Mena to sort of talk about, you know, the GST and capital gains tax considerations associated with that decision. But from a investment standpoint, you've got to recognize that what you've done is you've changed the nature of the property, and that will then typically change the nature of the future investment returns as well. So what I mean by that, typically when we go and buy a development site, we're spending hopefully most of the money on the land, the underlying land. And as we know, land appreciates in value, buildings do not necessarily appreciate in value, they typically depreciate. And so for after capital growth, then what we need to do is buy a heavy land value asset, so one where the improvements aren't that substantial, and keep it for long term and enjoy that compounding capital growth. However, once you've developed a property, what you've now probably got is an asset where the improvements could be more than the value of the land. In that situation, you're going to enjoy a high rental income yield, but you're going to pay tax on that rental income each year, whereas obviously you don't pay tax on capital growth until you actually sell the asset. So you get to compound that return each year and delay paying the tax until you eventually sell the asset. And And that's what does the heavy lifting in terms of building wealth. So that's one of the things that I would encourage people to think about is that, okay, sure, you've developed this asset and you can get dazzled a little bit by its income profile in terms of the amount of rental income you can receive. But what you've got to think about is what will the asset be worth in 10 years from now or 20 years from now? And if I took my profit and invested in an asset that is going to compound over that time, what would that asset be worth? And I think that's a really important consideration. But let's get into the boring tax considerations, Mena.
Thanks. Good lead-in, Stuart. Appreciate it. So the first thing to consider is what your intention is with the property itself. All right. So are you building to sell? Are you building to retain? Are you looking to live in one post-development? Establishing this intention from the start is imperative because it has, like I mentioned before, GST and CGT implications. So if you're building to sell, for example, you're going to be registered for GST. You're going to be claiming GST along the way, throughout the development, and you're more likely than not will be using the margin scheme. So what that means is you'll be paying GST on the sale, but at a much reduced rate because you've opted into the margin scheme. Now, if you're building to retain, then you're going to be on what we call capital account. So then after 5 years, if you come to sell the property, you're going to be eligible for the 50% CGT discount. Now, you got to consider here whether you want to be having the property in a company or a trust. Obviously, companies don't yield the CGT discount, but have a sort of lower land tax proposition than trusts. So there are trade-offs. So doing your feasibility and analysis around these sort of structures is really important to do with your holistic accountant. Now, lastly, if you're looking to sort of build and, retain one property to live in, it's a very common sort of approach where, you might have a dual occupancy where you look to sort of upgrade your property without actually moving, but you just want something newer, a bit more shiny. So you build a dual occupancy, retain one and either rent the other or sell it off. So here we use what we call partition agreements. So it allows you to sort of transfer the other property that you don't retain without incurring stamp duty. And these are particularly good with joint ventures. So you might, for example, go into a JV with, someone else in your family or builder or an investor. So, using these types of arrangements really help with those kind of JVs or joint ventures.
Which is a good segue into talking about joint ventures, Mena. And the reason people might enter into a joint venture might be sort of twofold. Firstly, from a financial support perspective. So if you own or a person owns an asset but isn't in the financial position to be able to develop that asset, or maybe they could enter into a joint venture with someone that does have the either access to borrowing capacity or cash in order to complete that development. Alternatively, you could be attracted to a joint venture because of experience and knowledge. So using a similar example, if you've got a property but you've never been through a development before, maybe doing a joint venture with someone that has a lot of experience that obviously is going to put a bit of time into sort of pointing you in the right direction, using their contacts that they've probably worked many years to accumulate, is going to obviously add value. I think joint ventures work really well when each joint venture partner needs each other. Someone that has lots of knowledge and lots of finance, putting two people like that together, where's the value really? They could do it on their own. Putting together someone with money but no knowledge together with someone that has the knowledge but no money, it's like a perfect marriage really, because they kind of need each other. Are there anything else we need to think about with joint ventures, Mena?
Of course, obviously having your legal agreements in place as you would with any sort of business partnership, things are all rosy at the start, but things can also go very sour very quick. So having sort of an agreement in place that dictates what happens in the event of any sort of contentions or issues that may arise is really important to have. Lastly, it's really important to choose a reputable builder. Cheapest is not best. Let me just say that from experience. Don't always choose the cheapest out there because, it improves your margins or, they promise the world. Choose a reputable builder, look at their reviews, talk to people that have built with that builder before, have a walk through their previous builds and check your home warranty insurance policies thoroughly.
So there's some of the considerations that you might want to take into account if you're going to undertake a property development. Making sure you've got a right team around you is really critical. I think with lots of different things, if you're in business or whatever you might be doing. And ultimately what we hope to achieve there is learn from other people's mistakes rather than make our own mistakes to create those learnings, which can be very expensive, of course. So that's it from us for this week. Until next week, bye for now.